Trent Bradshaw, Brandon Rogers, Bradshaw Financial Planning, and Mind Your Money. Wanted to bring you a market update, but we're also going to talk about some behavioral finance and investor psychology today. Please take a look at what we've got here because we're definitely experiencing a lot of this. But a couple things we're going to touch on today. First, we're going to talk about some important days here in July that are coming up. I'll touch on those real quick. And then Brandon, we'll defer over to you to talk about this investor psychology. All right, a couple important dates that are coming up in July here. Actually tomorrow, which by the time you get this video, it may be as of the same day or a day after, but on July 13th, the CPI Labor Department is, the CPI numbers coming out. Labor Department will release the overall inflation numbers for the month of June. Right now, they're expecting that to come in around 8.8%, which is greater than 8.6%. Of what we experienced in the May time frame. So if that occurs, that's going to give the fuel that the Fed needs to go ahead and increase at least another 75 basis points or more coming up on July 27th, which would be our second most important day here in July when it comes to the market, because that's when the rate decision is going to be made by the Federal Reserve around 2 p.m. on the afternoon. So we'll definitely pay attention to that. But then, Brandon, you touched on this. On July 28th, we get the big number. The big number is the GDP number, the gross domestic product for the second quarter of 2022. If this number comes in negative, we're officially going to have the definition of a recession. So we will be in recession at that point, again, if we get a negative print. Chances are that is what we're looking at. But we'll have to wait and see what that number comes out to be, toward the end of the month.
And I think the overall market too kind of has that in a way priced in. I think everybody's kind of leaning towards it. It really feels like we're in a recession. When we get this number, it's obviously a number from the past of what the GDP or gross domestic product is. So, a lot of people think that we're already in it right now, but that just number would potentially confirm it. So. Right,
and again, I think if we go back and look at the other rate hikes that we've had this year, we're kind of expecting the same thing on July 27th. We're expecting to see the market might have a positive reaction to it because, the last rate hikes that we've had, the market's gone up 500 to 1,000 points each time we've had it. Now, did it last? No, it didn't. It faded after that because, again, additional uncertainty comes into the market. But after this rate hike, Brandon, I think both of us are in the same camp that we think the Fed might take a breather. Going into the September 21st meeting. But the reason we want to point these dates out is because we think the Fed is so important in driving where the market goes going forward. So we've got to pay attention to it. We've got to bring you up to speed on what's going on there because it's something that we utilize to make the decisions in the portfolio. But that second half comes into play too, which we talked about, Brandon, which is investor psychology and behavioral finance. Touch a little bit on that so the individual investors, obviously our clients and prospective clients that are listening to this can understand what's going on right now.
Yeah, again, everybody has that emotional reaction to what's going on in the market. Nobody likes seeing the market down or the economy where it's at. So when you're looking at that, those are just real emotions that you're experiencing. So we got this first chart on here that just gives a couple of different examples on here. Obviously, I say that top one's it's the small bubble, but I think it's the biggest one. It's fear, right? Fear is going to drive a lot of action and a lot of uncertainty in your mind, and as it comes to the economy, the investment accounts, just life in general, right? So fear is a massive thing that's out there that you need to understand that, hey, it's real, it's a real emotion, it's happening, but let's take a look at the big picture and where we are overall. What does your plan look like, and make sure everything's still on track. Don't get caught up in just such the near term. Social influences, obviously we've got the media and social media out there is a massive part of it. Herding mentality, this is, doing what maybe your coworker does type deal. We hear that a lot. Regret aversion, chasing trends, loss aversion. Yeah, nobody wants to lose money. It's uncomfortable, but it's part of being a long-term investor. And again, key on long-term because we're in this for long term. You might be nearing retirement or in retirement, but still, the theory here is to hold these accounts for the rest of your life, which again could be 10, 20, 30, 40 plus years. So we got a long time to weather some of these ups and downs, but don't let the emotion really override and get yourself in trouble.
But really that boils down to the financial goal plan and looking at the financial plan and how is it impacted by what the current market conditions that we've gone through. Has your plan changed? Has there been adjustments that we need to make because you were too aggressive? Well, maybe so, but that's something we review when we go through that process. So we want to make sure you're on target, even though we've had some tough markets this year, without a doubt.
Yeah. So next slide we'll look at, basically, you kind of look at the blue line. Think of it as the following of the market. Obviously, when the market's trending upward, everybody's happy. You're excited, you get exuberance, your point of maximum risk kind of tops out, meaning, hey, I'm feeling pretty good. Well, how long can this up market really last? And again, historically, we know this is going to happen. It's going to happen. A downturn will happen. So as you start experiencing that downturn, we're in this year. You definitely felt the denial, the fear, the desperation, the panic type deal. That's probably where we're at right now.
I was going to say we would be in that desperation, the panic mode. I don't think we've hit capitulation yet. I think we might have one more drawdown, and then people just get to, from a psychological standpoint, say, hey, I've had enough.
Yeah.
But I don't think we've got there yet. And we kind of judge that on, the current client base that we've gotten and what other prospective clients are telling us when they come in.
Yeah.
So I don't think we're there yet. But remember, when we get there, it's probably one of the better buying opportunities that you can have.
Yeah, and that's the worst thing you want to do, is that knee-jerk reaction, let your emotions consume you and say, hey, I need to get out. I gotta do something. I gotta stop the bleeding. But usually when that happens, it's already too late. And, we need to ride it out because, again, think about it. We're long-term, and it's all about the financial plan and that big picture look. So that's really what's going to keep you grounded from where you're at, because you don't want to sell down at the bottom and then you miss the upswing and then you want to get back in and you've already missed it, right? So again, it's impossible to determine when these points are. We just have to experience them and make sure our risk is in check. And once we kind of get out of this thing and things turn around, then it might be an opportunity to readjust your risk tolerance and see what changes you might need to make. But again, all these are real emotions that you'll experience throughout investing in the market. Next two charts, we've seen them before. Again, they're just too important not to bring up again. So you look at this next chart we're looking at. This is just the S&P 500. We're talking about the intra-year swings on where we're at. So again, we're about halfway through the year. Market's down, around 19-20% or so at this point in time for the year. Again, we're kind of halfway. That's just the first half. Well, as you can see historically, you will have about a 14% average intra-year decline every year,
which is significant.
That's massive.
And when you look at the chart, you can look at the black dots on the bottom side of the chart. At times the market will go down 35 to as much as almost 50% in a year and within the year. And you talk about emotions and investor psychology taking it on the chin. That'll do it.
Yeah. And another key stat I kind of wanted to point out too is just really, if you look at the past 50 years of the returns of the S&P 500, you're really only seeing, again, being down to mark about 19-20%, you're only seeing about 3 times in the last 50 years that the market actually finished the year at that level as well, or lower. So, So again, that's something really to keep in mind as well, to think about, hey, this isn't, there's a lot of intra-year declines, and this chart does a fantastic job of looking at it. And then just really kind of big picture, again, we've seen this chart before too, but again, just the U.S. stock market from 1952 up to about current day. You see all the nasty events that's happened down across the bottom. You're going to have your ups and your downs, but again, you see that trend line actually just trending upward. And again, that's what the long-term investor will experience. But there will be bumps in the road, and we're right in the middle of one of those massive bumps right now. And it's uncomfortable, but it's normal.
Right.
So again, so just keep focused, stick to the plan, reach out to us if there are any questions or concerns, because again, this is the time we need to have conversations to put things in perspective, and most of the time you're feeling a lot better once we finish that conversation and we look at your plan long term. So again, remember, it's a long-term game. If there's anything that comes up, let us know. But thanks for joining us today. Brandon Rogers and Trent Bradshaw with Mind Your Money, Bradshaw Financial Planning.